Hi, and welcome to the Stockscores Market Minutes for November 14th, 2011. This week what I plan to do is take a look at the charts, but not only tell you what I think of the charts, but sort of try to teach you a little bit about how you read charts. It's really not that difficult, some very simple concepts. If you put them all together, you can do this as well. So the first chart that we have is the euro, and if you've been watching this video for the last few weeks, we know that this is a pretty critical chart right now. And there's a few different things going on here. The first thing I want to highlight is the fact that we have falling tops on this chart. So I've identified those in black. Anytime you have tops falling, it means the sellers are not, or pardon me, the buyers are not very strong because they were able to push prices higher in the past than they are in the more recent past. That's why we have falling tops. Now the blue lines are rising bottoms, and you can see that we have two rising bottoms on this chart as well as two falling tops. Now rising bottoms are a sign that the buyers are gaining some momentum and the sellers are losing some momentum. So we have both going on right now. We have the tops falling, which is a pessimistic sign, and you have the bottoms rising, which is an optimistic sign. And so in some ways they cancel each other out. Now the next thing that I want everyone to notice is the pattern that you see on the in red here. Notice I've drawn a line across these shorter term tops and it's falling quite steeply, and there's a line across the bottoms which is not falling as fast. That's called a wedge pattern. What it means is that every time price is pushed lower, it isn't with as much intensity as the previous time, and that's a sign that the sellers are losing their power. Now wedges are really only important if you get a break to the upside from the wedge. And so what we have is I would call it a neutral to slightly negative pattern, because we have rising bottoms and falling tops. So the blue is rising bottoms, the black is falling tops. However, we are lower than the previous range, and so that's a negative. But the positive is that we have this wedge pattern building, which is a sign that the sellers are losing their momentum, their enthusiasm. So the chart overall on the euro is still not great. I don't want anyone to think that I'm positive on this, but it's not as bad as it was in September, obviously. And it's really strikes me as a chart that's just kind of seeing some profit taking after what happened in October when we had a pretty good rally in the euro. So if you think about the political situation in the world, I think what we're seeing is that the market is becoming less concerned about the euro, but they are still concerned about what's happening in Europe. All right. This is the US dollar, and it's going to be pretty similar in some ways to the message of the euro, because of course the US dollar was in a pretty strong downward trend. We saw that way back in here, and that was because the US currency was being devalued by all of the printing of money. Well, the next principle I want everyone to notice is the fact that the bottoms and the tops are converging toward one another. In other words, we have a lot more price volatility on this side of the chart than what we have over here. And the reason that that's important is because volatility is a sign of uncertainty. And so you have more uncertainty here than you have more recently. And it's important to notice that because investors don't like to act when there's uncertainty. And so the US dollar is more pessimistic than optimistic. In other words, more likely to go lower, but not sharply so, and confidence is building. We are seeing less volatility in the US dollar. Alright, so the message of the US dollar tells us that again, the world, most notably Europe, is getting more stable than it was, but still lots of problems to be solved. And I think that sort of coincides with what we see in the headlines. Alright, here's the chart of gold, and this pattern that's building in gold is called an ascending triangle. Now we've talked about this in recent weeks where we had this upward trend line. The market really ran away from the upward trend line in August. It came back to the trend line. That's what we expect. That's pretty normal. And now we're moving up away from the upward trend line again. I think gold in the longer term is going to do something like this. It's going to build this pattern of consolidation. So this was the last run, and we're just going to kind of wind in here like that. So right now we are on the upswing. We're going to hit resistance. We're going to fall back. Longer term, if we're talking a few months out, look for gold to more or less be sideways between 160 and 185 on the ETF. That's the GLD ETF. And if you have a really long-term outlook, well, this is an optimistic pattern, so it points to higher prices in the longer term. All right, next up, chart of oil. Now, what I've highlighted on this chart is a downward sloping channel. You can see we have two parallel lines drawn across the tops and bottoms, and the market pretty much oscillated in between them. What happened in October is we broke to the upside out of that channel. That is a positive. That is an indication that this market wants to go higher. However, we still have lots of pessimistic overhang in oil prices from the past year of trading in oil. And so this strength is encouraging, but it's most likely that we'll see a pullback before we go higher. So I like oil longer term. I think it's probably headed back to the highs of April and May. But in the short term, expect some volatility along the way. Now, oil right now is one of the top performing things that we trade. I mean, of course, it's a commodity, but it's one of the things that's actually shown some decent strength through November, while most things have been pretty wishy-washy. S&P 500 is actually performing better than most global stock markets. Now, we had that rally in October, and we are now in what's called a pennant pattern. Pennant pattern means that the tops are falling, the bottoms are rising. What does that mean? We talked about this before already. Volatility is diminishing over time. There's more volatility here than there is over here. What that means is that investors are gaining some confidence that the prices that they have given to stocks are accurate. Fear is coming out of the market, more confidence. We're probably going to continue to wind our way in this pattern, and ultimately what will be important is what direction we break out of the pattern. Now, the rule for this type of pattern is the direction into the pennant is usually the direction that comes out of the pennant. And so that's why I've been short-term optimistic. However, only short-term optimistic because we got all this overhead resistance. All of this, people that own stocks at higher prices are looking to sell into strength. And if we think about the really long-term outlook, which we discussed last week, we still have this big breakdown that we have to overcome, and the market hasn't done that yet. So I would say cautiously optimistic about U.S. stocks. Canadian stocks, the chart looks very similar to oil, and if anyone has ever traded the Canadian market, you know that there's a lot of oil and gas companies in Canada and, of course, listed on the Toronto Stock Exchange. So it's not really a coincidence that the TSX, like the oil market, has broken out of a downward channel. That means it's likely starting a new upward leg. However, it's going to take time because all of this stock that's owned at higher prices is going to take time to work through. So here's my ratings. Optimistic for everything again, but I have to say that optimism comes with a high degree of caution. All of these things are breaking into overhead resistance. That means people will sell into strength. That means there's going to be a lot of uncertain, wishy-washy trading, a lot of whipsaws, that sort of thing. So, as I've said in recent weeks, really the bull market right now is in volatility. The way to make money in this market is to trade volatility, not to trade the trend in prices of stocks or commodities, but rather trade the volatility that comes in these things. Buy weakness, sell strength, or do what I'm doing, which is trade the ETFs that focus on volatility, namely the VXX, listed on Toronto T.VXX, which is the volatility index based on options volatility. And that's what I'm doing now, and it's working, but of course we'll change that as soon as the market gets a little bit more back to normal. Well, that has been the Stockscores Market Minutes. A reminder that you can sign up for my free weekly newsletter if you go to stockscores.com/newsletters.asp. Sign up there for that weekly newsletter. We'll only send you the newsletter, not a bunch of garbage, spam, or anything like that. Have a great week in the market, and trade well.